Well, for more on that APRA change, Anthony Landahl joining us from Equilibria Finance. Anthony, so we had the RBA talking about it. APRA has moved 50 basis points. That is increasing that serviceability buffer. Is that going to make much change?
Yeah, thanks, Andrew, and nice to be here, mate. Look, I think overall the impact's going to be fairly modest. This is at the backdrop of the RBA meeting yesterday where they're talking about longer-term financial stability. And secondly, it's also on the back of increased levels of household debt. So this move to increase the buffer rate really is in response to three main things. Levels of household debt are growing in relative to income growth. Debt to income ratios are about 6 times pre-tax income, and 22% of loans into the June quarter recorded that level, and that's a high. 2 years ago it was 15%, so there's concern around that, and there's also concern around the long-term financial stability. So this isn't so much in response to the housing market and house prices increase, it's very much in response to household debt. Some rough calculations are it might have about a 5% impact on a borrower's overall capacity and their borrowing capacity.
And which borrowers are they targeting, do you think? Are they most concerned about those trying to get into the market who are perhaps overextending themselves, i.e. the first home buyers?
Yeah, that's a really good question because it's going to be varied. Increasing the buffer rate has the effect of really targeting those that are more highly leveraged. So there's actually a chance that this is going to impact your investors who are already maybe highly leveraged. It's going to impact some first home buyers who are trying to borrow to their capacity, but I think it's important to note with first home buyers, they're often restricted by their size of their deposit as well. So it may have minimal impact on first home buyers. That'll be interesting. But I also think it's going to be targeting those with a high deposit, with high incomes, who are trying to maximise their servicing. I think they're going to be impacted as well. But I think investors are going to see some impact, partly because they're already fairly highly leveraged, and an increase in that buffer rate is really targeting leverage as much as a specific debt to income ratio or an increase in the floor rate, which might have more of an impact on owner-occupiers.
It's interesting though, because I think the last time that we saw these macroprudential regulations tightened, there was real concern about investors. That's not really the case now.
No, this is not targeted at investors at all. We're actually seeing interest-only loans drop. We're actually seeing high loan-to-value ratios drop. So the real focus here is on levels of debt, and the real focus is also on longer-term financial stability. And the RBA governor reinforced that yesterday, that their mid-range view was that interest rates were going to remain fairly stable, but they did give a pretty good nudge, as you indicated, to the regulator around levels of household debt. And as I said, to the end of the June quarter, over 20% of loans through that time had a debt to income ratio, or the level of debt in relation to their pre-tax income, at over 6 times. So that really is the target, as distinct from a specific sector of the environment.
But Anthony, as you said at the outset, it's not really going to address that issue of where house prices are going at the moment, in particular the issue of affordability.
No, it's not. And housing prices has been driven by two things. It's been driven by a low interest rate environment. It's been driven by low supply, and it's also been driven by cashed up buyers. Now, there may be a downstream effect here where people's capacity decreases, so it may have some impact on demand. And I think the other thing that will come into play, particularly through the spring and summer season, is we are seeing an increase in supply on the market with the end of the lockdowns and our traditional spring selling season. So there may be a downstream effect on housing prices, which may then help affordability with supply and demand normalising a little bit. But I don't think this buffer rate will be more of a downstream effect than a targeted effect on housing prices. But we may see some impact in combination with other things, including increased supply.
Well, and are we likely then to get more intervention from regulators, do you think?
Yeah, there is talk already of additional intervention. Most of the providers have indicated they're going to bring this change in, and APRA have indicated that there's a grace period through till the end of October. I think if there is additional intervention, it will then become a little bit more targeted. It might focus on debt to income ratios. It may focus on serviceability floor rates, and it may focus on specific types of lending, whereas this is a fairly general change that is really focusing on debt levels and leverageability. So there may be more to come, especially if this has a fairly modest effect across the economy.
Anthony, thanks for pulling that apart for us. Thanks for joining us from Equilibria Finance.
No worries, Andrew. Thanks for having me.
See you, mate.